Money feels simple when it's in your hand or on your phone, but the journey it takes to reach you is anything but simple. From the moment money is created by central banks to how it's multiplied through loans, controlled by policy, and finally spent by you, there's an invisible system working behind the scenes. Most people earn money, save it, and spend it without ever understanding who creates it, why its value changes, or how power and trust keep it alive. In this video, we'll uncover how money really works from printing to your pocket, and why understanding this system can change the way you see wealth, debt, and your own financial future. Today we will talk about how money really works from printing to your pocket. So before we start, make sure to hit the like button and subscribe to my channel. 1. What money really is and why it exists. Money is not just paper, metal, or numbers on a screen. It is a shared belief system that allows economies to function. Long before modern currencies, people relied on barter systems, trading goods like grain, cattle, or tools. These systems were inefficient because both parties had to want what the other offered. Money solved this problem by acting as a medium of exchange, a unit of account, and a store of value. Over time, societies agreed to trust certain objects, coins, notes, or digital balances, as money. This trust is crucial because modern money is not backed by gold in most countries. It is fiat money, meaning its value comes from government authority and public confidence. Without trust in institutions, laws, and economic stability, money loses its power, as seen in cases of hyperinflation. 2. Who decides how much money exists? The supply of money in an economy is primarily controlled by a country's central bank, such as the Federal Reserve, European Central Bank, or State Bank. These institutions do not act randomly. They carefully adjust money supply to balance growth and inflation. Central banks use tools like interest rates, reserve requirements, and open market operations to manage liquidity. When economies slow down, central banks may increase money supply to encourage spending and investment. When inflation rises too fast, they reduce it to cool the economy. Governments do not simply print money whenever they want because excessive money creation reduces purchasing power. Every decision about money supply is tied to employment prices and economic stability, making central banking one of the most powerful forces in modern society. 3. The process of printing physical money. Physical money begins its journey in highly secure government printing facilities. These mints and printing presses use special paper, ink, and advanced anti-counterfeiting technologies like watermarks, holograms, and microprinting. The designs are approved by government authorities and central banks. However, printing cash is only a small part of money creation. Physical currency usually represents a minor percentage of total money in circulation. Once printed, banknotes are distributed to commercial banks through central banks. Old or damaged notes are removed and destroyed regularly. Despite the dramatic idea of printing presses running non-stop, most modern economies rely far more on digital money than physical cash. Printing money alone does not make a country richer. Productivity and trust are what truly give money value. 4. How digital money is created. The majority of money today exists only in digital form. When banks issue loans, new money is effectively created. For example, when a bank approves a loan, it credits the borrower's account with funds that did not previously exist as cash. This process is known as fractional reserve banking. Banks are only required to keep a fraction of deposits as reserves, allowing them to lend the rest. This system expands the money supply and fuels economic activity. However, it also creates risk, which is why banks are regulated. Digital money moves instantly through electronic transfers, cards, and online platforms. While it may seem invisible, digital money drives global trade, investments, salaries, and everyday purchases far more than physical currency ever could. 5. The role of commercial banks. Commercial banks act as the bridge between central banks and the public. They accept deposits, provide loans, and facilitate payments. Banks earn profit by charging interest on loans while paying lower interest on deposits. When you deposit money, the bank does not lock it away. It uses it to lend to others. This lending process multiplies money within the economy. Banks also play a critical role in assessing risk, deciding who receives credit and who does not. Poor lending decisions can lead to financial crisis, as seen in 2008. Because banks are so important, governments often ensure deposits and regulate banking activities to protect the economy and maintain public confidence in the financial system. 6. How money moves through the economy. Once money is created, it flows through salaries, businesses, governments, and consumers. Employers pay wages, consumers spend money on goods and services, and businesses reinvest profits. Governments collect taxes and redistribute money through public services like healthcare, infrastructure, and education. Each transaction keeps money circulating, which economists call velocity of money. If people stop spending and start hoarding cash, economic activity slows. This is why governments encourage spending during recessions. Every purchase you make contributes to someone else's income. Money is not static. It is constantly moving, changing hands, and reshaping economic outcomes. The health of an economy depends not just on how much money exists, but on how efficiently and fairly it circulates. 7. Inflation, deflation, and purchasing power. Inflation occurs when prices rise and money loses purchasing power. Deflation is the opposite, where prices fall and money gains value. Moderate inflation is considered healthy because it encourages spending and investment. However, high inflation erodes savings and hurts fixed-income earners. Inflation often results from excessive money supply shortages, or rising production costs. Central banks aim to keep inflation stable through monetary policy. Deflation, while sounding positive, can be dangerous because it encourages people to delay spending, slowing economic growth. Understanding inflation helps people make better financial decisions, such as investing instead of holding cash. The real value of money is not what is printed on it, but what it can buy over time. 8. Government spending and public debt. Governments use money to fund public services, welfare programs, defense, and development projects. When tax revenue is insufficient, governments borrow money by issuing bonds. This creates public debt. Contrary to popular belief, debt is not always bad. It can support long-term growth if managed properly. Problems arise when debt grows faster than the economy's ability to repay it. Central banks may buy government bonds, injecting money into the system. This close relationship between governments and central banks influences interest rates and inflation. Responsible fiscal management ensures that borrowed money benefits future generations rather than burdening them. Government spending decisions shape infrastructure, education, and overall quality of life. 9. From banks to your pocket. Money reaches your pocket through salaries, business income, government benefits, or investments. Every paycheck reflects layers of economic activity, banking systems, and policy decisions. When you swipe a card or use a mobile app, digital money moves through payment networks in seconds. Your spending choices influence markets, businesses, and even employment. Saving and investing determine how money grows or shrinks over time. Personal finance is deeply connected to the larger financial system. Understanding how money reaches you helps you manage it wisely. Whether you save, spend, or invest, you are participating in a vast global system that connects millions of people and institutions every second. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.